morning. Hello, everyone, and welcome to the INN8 Invest Q3 webinar, Unlocking Investment Opportunities in South Africa. For much of 2025, we've been talking about global opportunities, but we forget that there are many great stories here in SA. And of course, many of our big corporates do earn overseas as well, making the story a little bit more complicated. As usual, we're going to start today with a performance update on the INN8 Invest solutions, followed by a discussion with asset managers. Today, we'll be joined by Truffle, Lorium, and Bateleur, all interesting boutique managers that form part of our award-winning INN8 Invest portfolios. We'll also end off today with something a little bit different, which is a chat with Sherry Lee Stratford from the new Standard Bank International Investment Platform, who will be able to share some of the exciting developments coming through that platform. As always, please don't forget the benefits of a good DFM partner. It should be flexible, it should provide you with benefits, not restrictions, and it should never try to take over the advisor-client relationship. Part of the reason INN8 Invest has been winning awards is rooted in this focus on delivering choice and performance to our advisor partners. If you'd like to find out more about our models, our amazing living annuity solutions, or our global options, please do reach out for us. Lastly, before we kick off, I appreciate the effort that you've all made to dial in today. There will be CPD points available, but please do feel free to ask questions and make this webinar useful for you. The more interactive it is, the better. You can use the Q&A function to post questions and we'll pick them up and get our speakers to answer them wherever we can. I did mention performance, so let's start with a performance update from one of our portfolio managers. Today, we're joined by Sonal Bhagwan, portfolio manager at INN8 Invest. Sonal, welcome.
Thanks, Andrew. Just give me a sec to share.
No worries.
Am I sharing? No. There we go. It should be right now.
It is.
Thank you, Andrew. So, Trump has been a busy man since he came into office. Most notably, in the 3 months leading to the end of July, he has been on a Middle East tour where he concluded on some strategic agreements. He had the controversial Oval Office meeting with Ramaphosa. He instituted some travel bans against some foreign nationals. The amended reciprocal tariffs were announced across multiple countries at the end of July, ranging from 10% to 41%. And more recently, he has spearheaded talks to de-escalate tensions in Ukraine. His bold and sometimes unconventional approach to negotiation has kept markets on edge. More importantly, there has been an elevated focus on the US. As we know, when the US sneezes, we all catch a cold. The impact of tariffs has been a talking point for long. Trump has noted the impact on inflation will be once off, whilst Powell notes this is not a certainty. It is hard to assess the full impact given the tariffs have not worked through the entire economy as yet. Additionally, the on and off amendment of tariffs makes the assessment much harder. There has been pressure from Trump and other critics for rate cuts to boost the economy. And up until the Jackson Hole Symposium, Powell has been quite anchored in his wait-and-see approach. At the symposium, he noted that downside risks are rising in the labor market and the economy. A shift in the balance of risk may, and this would be in capital letters, bold and red, may warrant a change in policy stance. The market reacted quite well to this dovish tone, with equities rallying and treasury yields dropping. As of this morning, according to the CME FedWatch tool, 87% of market participants believe a 25 basis rate cut will be delivered at the September meeting. So if we look at the major asset classes, one can see for the 3 months ended July, global equities in Rand terms was the best performer, and that's despite the Rand actually strengthening by 2.1% over this period. Global bonds, on the other hand, delivered muted returns in USD terms, which then resulted in a negative 1.9% in Rand terms. And if you look at your risk assets, SA bonds, SA equity, and SA property, also delivering quite healthy returns over this period. And then if we look longer for the 12-month period, you can see SA risk assets have actually been the stunning performers. Here, SA property being the best performer, followed by SA equity and SA bonds. Global equity not too far behind at 15.2%, but the picture is it was a good time to be invested in risk assets in general. So looking at the model performances, one, just to note that these models have been live for just over 3.5 years. So if we look at the 3-month return over there to the end of July, all the models have outperformed their relevant peer benchmarks. Looking longer, the models have done well relevant to their versus their relevant peer benchmark, as well as their CPI objective. So happy with the performance over there. Just to note some of the performance drivers for these models, you can see SA bond exposure has been a contributor or a driver across MP1 to MP3, so flexible income to moderate growth, while equity exposure, whether global and SA actually, has been a contributor from MP2 to MP5, so stable, moderate, high, and flexible growth. So if we dig a bit deeper into the underlying managers, one can see Amplify Strategic Income did really well over the quarter. Their more aggressive duration positioning worked for them, as well as the SA property exposure assisted their portfolio. The Visio Unconstrained Fixed Interest Fund also had a more aggressive bond positioning that worked well. The SMM Global Flexible Fund of Fund, here offshore equity was what drove this fund of fund, and more specifically, the likes of Sands Capital, that's a growth manager, performed really well for the solution. Then Truffle Flexible Fund, here we had good stock selection, and the overweight to Nasdaq's process worked well for the fund. In the case of Lorium, they also had good stock selection, and their holdings in gold and PGMs did well for them. You can see AVAX, slightly more defensively positioned, which didn't work well over the quarter where risk assets did well, but this is as per expectation. And 91 Opportunity Fund, they provided downside protection during April, but lagged the sharp risk on recovery. So this just shows us a peek into the underlying managers within the SMM Global Flexible Fund of Fund. We have value managers like Dodge & Cox, Sanders Capital. We also have growth managers such as Sands Capital, Bailey Gifford, amongst others. The likes of Arrow Street Capital makes use of machine learning and AI-like techniques in their quantitative approach. Overall, these are some of the largest and most established global asset managers. They have deep expertise across markets and decades of investment experience. So, turning to the outlook. Despite the volatility, equities still posted a solid return year to date. And given a lot of market participants expect this Trump volatility to continue for the rest of his term, don't take that as a bad thing for risk assets, as we've seen year to date. And the economy is not necessarily the market. We know that more than 50% of the JSE's earnings are actually earned offshore. And then global GDP growth has been revised down in 2025 and 2026 by the IMF, and this is due to that heightened trade tensions and policy uncertainties. And in SA, valuations in some sectors do remain favorable. We know that growth challenge does remain. And the tariffs will negatively impact South Africa, especially the automotive and agricultural sectors, where there's an expectation of 30,000 jobs that are impacted. That being said, the presidency and the office of the presidency is still working on negotiations with the US. They've also set up a support desk for exporters to try and help them find other countries they can export to, and we'll see how that plays out. And last but not least, all this volatility actually creates great stock picking opportunities for our managers. And on that note, thank you. I'll hand back to you, Andrew.
Thanks, Sonal. I appreciate that. You can find information and fact sheets about these fund solutions from our investment specialists on the INN8 Invest website or on our DFM Advisor portal. And of course, on every major list platform as well. Whether you use Glacier 91, Allen Gray, Momentum Wealth, Old Mutual, Signia, Stanlib, or INN8, you can find our INN8 investment portfolios there. And we like to use these webinars to connect advisors with some of the asset managers that we use within those solutions. So I'm going to invite our guest asset managers to come online now, and each one will give a short introduction to showcase their philosophies and company. We'll then talk about how they're managing money in today's context and how they're working to ensure great investment outcomes. They'll each have 5 minutes, but time often does run out. So if you do take longer, I'm afraid I will interrupt you. I'm going to ask Warren Riley to come online first. Warren is a portfolio manager at Bateleur, where he has been since 2016, after roles at Cadence Capital and Allen Gray. Warren, welcome.
Thanks so much, Andrew, and thank you for the introduction.
Pleasure.
I'm going to begin with a brief overview of Bateleur Capital and take you through our flexible mandates, which we'll be focused on today, and then wrap it up with a brief view on how we see in the world. To begin, Bateleur Capital was founded now almost 20 years ago. So the business has a long track record that's been developed over the years. I think importantly, the core investment team at Bateleur has been together since founding. So there's a lot of institutional knowledge in the business. And we've grown steadily to today having just 17 employees and managing close to 19 billion in assets. I think our background is quite important as a hedge fund manager. We still today apply that across all our mandates, that hedge fund background, which means we have a very strong focus on capital preservation and avoiding downside risks. And importantly, we remain a focused business. We run 4 equity-centric funds, and we apply the same investment process across those funds. I think lastly, if you look at our track record we've developed over time, our long-short fund has now got over 20 years since inception, and it's annualized at 14.7% per year and at about half the risk of the market. If you turn to our flexible mandate, which was launched in 2010, I think we can speak to here our investment process. You can see that over the years, the outperformance that we've delivered has largely come during weaker market backdrops. And I've circled a few of those instances in, for instance, 2015-16, when the fund delivered almost over 17% against the market up 7.9%. And of course, 2011, when the fund was up 16% and the market was up only 2 or 3%. And I think that speaks to a couple of things. The way we manage the fund. So we manage this flexible mandate with a healthy level of cash, which allows us to deploy it and use it as dry powder during market corrections. And that has generally been the case over time, that we've been able to utilize this and limit the downside, but participate on the upside. So our flexible mandate has delivered 13.7% compound over almost 15 years. We recently launched, or almost 2 years ago, an SA flexible mandate that is compounded at 12.3%, and it's nearing a two-year track record. If you look at the backdrop to today's markets, I think it's important to set the scene. Markets continue to climb a wall of worry, as they have done historically. There's many things to worry about. You saw the April sell-off where global markets were down almost in the teens. We've seen the S&P 500 rally almost 30% off the lows. to now be at record highs, and many other markets have followed, despite a lot of noise and volatility out there. The US market continues to be dominated by the AI theme and hyperscalers. If you look at the returns generated by the S&P year to date, almost 60% of that is coming from 5 stocks, all linked to the AI trade. If you look at Europe, we're seeing some positive signs there. There's a change in approach to fiscal policy. Policymakers look like they're going to start spending more, which should be good for growth. And they've also cut rates far more aggressively than the US, given low inflation, which we think is quite supportive, but it'll probably take some time to feed into that economy. China, on the other hand, is stable. They've gone through a significant deleveraging in the property sector, and we are starting to see some incremental positives for the consumer coming through. That's obviously quite important for the JSE, given our large exposure to Naspers, Tencent, as well as the commodity counters. South Africa has been somewhat disappointing. At this time last year, we were looking for closer to 2% GDP growth. It seems we're going to print closer to 1% this year. What we're seeing with our interactions with corporates is that there's been limited improvement in the economy, and that the pace of reform is taking longer to come through. But against that, there are also a couple of green shoots coming through with the drop in interest rates and some improvements in consumption. Stepping back a bit, global valuations are generally elevated relative to history, given obviously the strong moves year to date. But what we are finding domestically is that there are many stock-specific opportunities and stock-picking opportunities, given the large dispersion in the market year to date. And I'm sure we'll chat about some of that today. So I'm going to leave it there and hand over to the next panelist, but look forward to the conversation.
Thanks, Warren. I appreciate that insight. We're next going to ask Saul Miller, who's a senior portfolio manager at Truffle, to come on. Saul also joined his firm in 2016 after more than 10 years working for RMB Asset Management and Argon Asset Management. Saul, thanks for joining us today. Saul, we can see your slides, but we can't hear you.
Apologies. Can you hear me?
There we go.
Great.
Perfect.
Sorry for that. Truffle started in 2008, which is about 17 years ago. Importantly, we are 45% owned by existing employees, and we also invest in the funds which our clients invest in. So our interests are very much aligned with our clients. We offer the full suite of funds, all the way from income funds up to equity funds. The fund we're going to be focusing on today is obviously the flexible fund. So that is just one step below equity in terms of the risk spectrum. If you look at the performance across all of our products, we are in the upper quartile since inception, and many of them are actually coming first. We have a sizable investment team on average. Our average analyst portfolio manager has 17 years of experience, and for the flexible fund, the PMs have about 3 decades of experience. With that, I quickly want to touch on our investment philosophy. Once we determine our investable universe in terms of equities, which is obviously the key asset class in a flexible fund, we will estimate an intrinsic value. Now, an intrinsic value is a value that should be smooth. It should grow at a smooth rate over time, and it's a function of the future cash flows and earnings that a company will generate. So unlike the share price, which is very volatile, this will be smooth, and that really means that we actually like volatile markets. It's that volatility in markets and in shares that gives us an opportunity to buy shares at a discount to intrinsic value. Now, not all intrinsic values are the same. In a country like South Africa, where there is very limited GDP growth, a lot of companies struggle to grow their earnings. So although you may see a lot of companies that optically look very cheap on, say, a PE or a price to book, if they don't generate earnings growth, you generally are not going to get a good return out of those companies. So we try to avoid those companies. It's not really enough just to pick winning shares. You have to avoid the losing shares as well. That is as important to give us our inflation-beating benchmarks, which we're trying to achieve in our various funds. Another important factor to mention in terms of an intrinsic value. It's obviously an estimate, and you can have varying degrees of conviction around what your intrinsic value is. So, I mean, you often get companies that might have a tremendous amount of upside based on your best estimate expectations. But if there is a high risk of that not being realized, and an example I often use is, say, a miner with a lot of debt. If the stuff that they're mining out the ground doesn't move to what would be a reasonable level or reasonable price level, that company might actually go bankrupt. So it's not enough just for a company to have a lot of upside. We need to have a fairly high conviction that it can reach that. So that really talks to our focus on protecting against downside for a fund like this. In terms of fixed income, we will make our estimate of where we think the yield curve will be, and that gives us a sense of what the expected returns are from government bonds. We'll also compare that to credit, which is also an important asset class for us, and that gives us a sense of how we balance out our exposure between credit and government bonds. In terms of asset allocation for all the assets, as I said earlier, for this type of fund, you would generally have quite a high exposure to equity, but there obviously is a band that we will move in, and that band will be a function of the bottom-up opportunities that we see in different asset classes and shares, as well as our view on overall valuation of markets, which will obviously correlate with whatever we own in our funds. And then finally, we try and reduce concentration to any particular sector and shares. We obviously want to diversify. We want diversified sources of return. We will also give quite a lot of thought to political and economic factors, both domestically and globally, that could impact the portfolio and ensure that the portfolio is robust and, in fact, would benefit from some of those potential outcomes, whether that is lackluster growth in SA, which we expect, or whether that is a move higher in, let's say, US bond rates that can obviously affect SA assets as well. That's the performance of the fund over time relative to our benchmark of inflation +5 and the equity markets. I think what's important to bear in mind is not just that this has outperformed the equity markets, but it's done it with a lot less volatility, which you can see in this slide. That is the current asset allocation. So we're sitting at about 74% in equity, and it's quite diversified across different asset classes. With that, thank you.
Thanks, Sol. I appreciate that overview and introduction. And lastly, we have Matthew Poundset, portfolio manager of the Laurium hedge funds. Matthew joined Laurium in 2013, and while he might be the youngest speaker, he impressively is both a chartered accountant and a CFA charter holder. Welcome to the call, Matthew.
Thank you very much, Andrew. Thanks for having me. I'll give an introduction to Laurium Capital, and obviously today we'll be talking about our Laurium SA Flexible Fund. We are also 17 years old. We just recently celebrated our 17th birthday. We actually started literally a few weeks before the Lehman crisis, so an interesting time to be born into financial markets. And if we look at what is our right to win, what is our edge, it really comes down to team, culture, and process. If we look at our team, we have on average 20 years of experience across the firm. So an amazing backdrop of people that have been through various market cycles, experienced many different market environments. And through that, we've developed quite a rigorous process. And then we've got culture. So we are effectively 100% owner managed, the only non-staff shareholders at Charitable Trust. Collectively, we are one of the largest investors in our funds as staff. So, very much an entrepreneurial business. We've developed obviously a very rigorous and disciplined investment process, and you need that. But we've coupled that with still having an incredibly flat structure, a boutique mindset, which I think makes us very nimble and fast moving. So really trying to kind of balance, those two attributes. Size is an interesting debate within asset management. Obviously, you need a certain number of people in your team. You need a certain level of scale to attract the best talent, to be able to do really in-depth research. But at the same time, the bigger you get, the more bureaucracy and process and complications you can actually end up receiving. You can actually get into diseconomies of scale. So really about finding that balance, and I think we've got a good balance in that regard. If we look at our process, we actually started life as a hedge fund manager. It was the first fund that we launched all the way back in 2008. And, we think that sort of hedge fund start brings pretty unique skill sets when managing multi-asset funds. So if you think about the ability to be nimble, the ability to see the relative attractiveness between asset classes, but also to do things like manage risk. I think that's incredibly important, and we can chat about that in a bit more detail in the panel. So really kind of taking those key hedge fund toolkits that we have and applying it to the multi-asset space. The first fund in the long-only arena that we started was the flexible fund mandate. And the reason why we did that was because it's the long-only mandate in which you can actually utilize that hedge fund toolkit or background to the fullest extent. So the bulk of what we do is fundamental analysis, but we really augment that with event-driven trades, which we could give some examples with, but then also this risk management framework that we have. And I suppose the proof points is in returns. This is quite a busy slide, but it effectively on that x-axis shows all the funds that we have at Laurium in the long-only space, and the bar charts are returns, and the shaded green area is the effective alpha that we've generated across the funds. And the reason why we like this slide is it kind of suggests that our process and our philosophy is both repeatable across funds and geographies, and really I think gives a lot of confidence around our process. And the fund obviously up here is our SA Flexible Fund. That's only started 2 years ago, but our other flex fund, which started 12.5 years ago, that was the first fund that we started in the long-only space, obviously with 12% return since inception and ranking third. And if you kind of look at the rankings across our multi-asset funds, we're either top decile or top quartile. So very proud of that. And then this is the SA Flexible Fund, again, only started 2 years ago, so short track record, only about 2 years old, but a very impressive start for the fund. So I'll leave it there and looking forward to the conversation.
Thanks very much, Matthew. Appreciate that. And I'm going to ask all three of you, Saul, Warren, and Matthew, to come on, because for the next 35 minutes or so, we're going to have a discussion amongst ourselves. Please, let's make it interactive. And I hope we're going to tease out some differences of opinion in terms of how to invest, because if it wasn't clear from those presentations, all three of you do have different approaches to the way you think about money. Truffle, if I can summarize it very basically, you're a bottom-up manager. Laurium, you take a bottom-up approach with a top-level overview, and then Bateleur, you're more top-down in terms of your investment approaches. So I expect that we're going to have some differences. So let's kick off. Saul, I have a question for you, just to set the scene. We've been spending so much time as an industry trying to invest overseas, particularly over the past few years. What's the appeal to investing in South Africa?
Well, I mean, I think there are obviously benefits to investing overseas in terms of getting extra diversification. So that's certainly understandable why people would want to do that. One of the benefits to SA investors of investing in SA is obviously they get access to a lot of overseas shares that are in our JSE index. So, I mean, I know that's a little bit different to what you're sort of asking me, which is why specifically in SA, which I'm going to get to. But I think it is just important to mention, and I'm sure the listeners know, that we don't just have access to offshore shares. We actually have access to fairly high quality offshore shares in SA. Probably one of the best luxury goods businesses in the world is listed here, being Richemont. It didn't used to be, but it certainly has transformed itself. And there are other examples of fairly high quality global businesses in SA. So I think that's important to bear in mind, that you're not just getting exposure to SA. The benefits of being exposed to some of the specific counters that are exposed to the SA economy is one of valuation as opposed to one of high growth. We do have a few high growth opportunities in SA despite a fairly tough economy. But if we put those aside for the moment, I'd say, if we look at financials, what we like about financials in South Africa is that they are particularly cheap. So even with a fairly lackluster outlook for SA GDP growth and with not particularly exciting prospects for growth in earnings, we actually see high teens returns from a lot of SA financials, which I think is a great return. I mean, it's very much an equity-like return, and that's obviously a big sector on the JSE. So we certainly find great valuation opportunities, and then there are some great growth opportunities. Certainly not that many, but there are a handful of shares that can take a lot of market share and can grow their earnings irrespective of what GDP is. And I mean, we would probably add to that list the likes of a Capitec or a Discovery. So you get that benefit as well in the SA market, and you see a lot of foreigners actually buying those shares. So there. Hopefully, I've given you a flavor of some of the benefits of being.
You have. And we'll talk about banks in a minute. I just want to see, Matthew, do you agree with that? Do you think that the opportunities are more in valuation rather than growth in South Africa?
Yes, I mean, there's good risk premium in South Africa, both in the equity market and the fixed income market. The other benefit for investors that you kind of need to be cognizant of is that you're matching your liabilities. So, you know, if you're an individual and you're reaching retirement, to a large extent, your liability stream is rand-based. And although we always think the rand is a one-way bet, it's not. It's hugely volatile. It depreciates and can appreciate quite aggressively versus the dollar. I think there's arguably a lot of concerns around the valuation of the dollar and the direction of policy making there. So the other benefit of investing locally is a better match of your liability and your asset base.
Thanks for that. Warren, do you agree with that? What are we talking about when we talk about unlocking SA opportunities? Is it SA Inc. or is it the rand hedges?
I think the opportunities really lie in the domestic market and the SA Inc. names. I mean, I think the interesting stat, if you look at what's happened in the market this year, is the divergence in returns from your local domestic-facing names versus the foreign and the rand hedge type shares. So you've had very soft performance domestically, and what we are finding currently is quite a lot of stock-specific opportunities, which we think will generate strong returns without the help from the economy. So we don't think you need strong GDP growth to still earn a suitable return from some of these names. So there's a lot of that occurring. And I think also going back to the idea of investing in South Africa versus offshore, I think it's also quite important that we live here and we're specialists in South Africa and understand these companies and the names quite well. We're able to interact closely with the management teams. I think that edge is important. And it definitely it adds to the total investment return over time.
Thanks. And while I've got you, Warren, you typically invest with a flexible mandate. How much benefit do you think there is in having a flexible mandate? And what are the sources of value add?
Yeah, I think over time, and I showed that slide earlier on our flexible mandate, which has now been running for over 15 years. That fund has been managed as a cash equity type fund. So when we look at it, we go, what is the value add from the equity selection? And over time, that fund's delivered returns ahead of the market, 1% per annum ahead of the market, and it also almost half the risk of the market. So compounding at 13.7 versus the JSE at 12.7. Other times, though, it's also been more important, the asset allocation decision. So we've always run that fund with a cash buffer and how we utilize that cash. So in times of market stress and drawdowns, I'll give an example of the post-COVID when the market had a 25% drawdown. We came into that start of the year with relatively high cash balances. Into that drawdown, having cash allows you to think very strategically. We're able to allocate that cash and increase our equity allocation by 10 percentage points. So what you see is that you don't feel the full drawdown in the fund, and then you're able to participate on the rebound. And that's then a similar type of event happened now more recently with the imposition of the tariffs in April. We were able to use some of the cash in the fund to acquire some of the securities. And if you look at the likes of the many domestic names, they fell 15 to 20% in a matter of a week. So we found many opportunities to use our cash there and put it to work. So to give you specific numbers as to where the value's been added is relatively hard, but I would say majority over time has come from equity selection, and that's been aided by our asset allocation, where the fund manager has the ability to make calls within the fund and attempt to add value via like market timing and so on.
I'm glad you mentioned that, because the question about the tension between the asset allocation and the security selection is a big one. So at Truffle, based on your investment philosophy, you believe that it's much easier to add value through security selection, or rather it's harder to add value through asset allocation than good security selection. Can you explain why?
Sure. I mean, when we talk about asset allocation, often what we're talking about is looking at an index in its entirety, whether it's the JSE or whether it's the S&P 500. You're looking at it as one unit, and you're usually looking at an economy as one unit. And often there's a lot of heterogeneity within an index and within an economy. I mean, even in the US, you've got almost a two-speed economy. You've got US consumers that are probably starting to struggle a bit, yet you've got this AI side of things that's going gangbusters. In SA, it's actually far worse if we look at our index. We have a huge amount of heterogeneity within our index. I mean, as I said earlier, like nearly half of our index is not really SA focused. It's resources, it's offshore luxury businesses, it's China via Naspers and Prosus, it's MTN, which is kind of Africa. And these aspects of our index are also hugely volatile. I mean, if you look at the volatility of, say, gold or of MTN, they're enormous and they're very unrelated to SA. And then half of our index is kind of the SA economy. So looking at the index as one unit, I think can be quite misleading. I mean, the other issue you have is, you're looking at the valuation of often of an index and you're comparing it to history. Our index has changed quite a lot if we go back to if we look where we are today versus where we were 10 years ago. The composition is so different. So to look at the PE now, or the dividend yield, or whatever metric you look at for our index and compare that to history is a bit misleading. We think it's far more meaningful to look at individual sectors and shares and assess the kind of return you can get from those. So that is why we find it easier and we can get more value by looking at things more from a bottom-up perspective. It's not to say that we don't look at a top-down. We do consider that. We just think that it's far harder to have conviction on overall market valuations, and it's also quite difficult to make assumptions about what a fair PE is for a market. We like to draw lines through history and assume that they mean revert. They don't really mean revert very, very nicely. So there's a lot more uncertainty in terms of asset allocation. Whereas from the bottom up, you can make sure that each share and each sector will give you the required return that you need to outperform your hurdle.
You mentioned gold, which I want to get to, but you just made a very strong case there that it's hard to get asset allocation correct. Matthew, Warren, do you want to rebut that in any way?
Look, I think it's right. I mean, security selection is a lot easier than making asset allocation decisions, because asset allocation decisions really require taking a strong macro view. And generally, analysts across the world are not good at getting macro right. The benefit, though, of having asset allocation at your disposal is that at any given point, you can find the securities or the assets which have the best risk asymmetry. So a great example of that was in 2023, leading up to our general election. Our sovereign bonds were trading at yields above 12%. At one stage, they reached 12.5%. And our local equities, the SA Inc. bucket that we're talking about here, were at depressed valuations. Okay, but we were going into a very uncertain political event. And what you can do when you have the ability to choose between different assets is look at the risk return profile and see which one is better. And at that stage, to a large extent, sovereign bonds were better. Because if things had gone well, which they subsequently did, the yields would tighten and it would be very possible over a 12-month window to make high teen returns, which subsequently did happen. If things had not gone well, the yields would have widened. But because of that high coupon that's embedded in the bonds, your 12-month return in an instrument like that, at worst might have been zero. Mm-hmm. So you had great asymmetry at that stage in bonds versus equities. What a flex fund allows you to do is make that valuation or risk asymmetry selection, as opposed to, we weren't taking a macro bet, we were looking at the relative valuation.
So having the hedge fund structure, if I can put words in your mouth, gives you the ability to use both. You can do bottom-up stock selection, but when you want to take a tactical position because you think a particular asset is in favor, you can get exposure to that. And that's sort of, I guess, what Warren was saying about the flexibility that he has on his mandate as well. The question that I just thought of when Saul was talking, is there more of a role for hedge funds today because of the concentration in the market? It's harder for a long-only manager to differentiate themselves if the number of counters is diminishing. So therefore, does it mean that actually there's more opportunity for hedge funds to meaningfully add value? Open question, whoever wants to answer that.
Yeah, let me have a go. Look, so we've been running hedge funds for 20 years, and I think over that time, what we have seen, and it's quite interesting, is that the hedge funds have stayed relatively small part of the South African asset allocation mix. I think if we looked at the end of 2024, there's 150 billion rand across the hedge fund industry. You'll probably know what that is as a percentage of total assets, but it's small. And I think that importantly then leads to the next point, in that if you look at our hedge funds, they remain quite small against our asset base, and allows us to participate in a lot of opportunities. So that purely having a wider opportunity set certainly does provide more opportunity in the SA context. A lot of stock-specific opportunities, corporate actions. I mean, I'm just looking this morning, Curro, the schooling group's being taken private for a 60% premium from last night's close. That kind of opportunity in the mid-cap space, size will allow you access to that. You just can't participate in some of these bigger mandates.
Did you have a position in Curro? Can I put you on the spot?
No, unfortunately, we didn't, but it was quite frustrating, because that was a name that we've been doing quite a lot of work on. We're not expecting a bite. We did own some Adcock Ingram, which was bought out last week, the week before. And I think it's another sign of what's happening in South Africa. There's a lot of very cheap counters and that are being ignored because of liquidity and the market's focus being on the top 40 large caps. And either the companies just continue delivering those results, and if they don't re-rate, generally you'll see them being taken private. Because but in both cases, these companies taken private at very attractive valuations.
Yeah.
Maybe to add to that, and it reverts back to the question, Andrew, that you asked earlier about the benefits of the local market.
Well, the concentration of the market, whether it actually favors hedge funds a bit more than local.
No, so I'm reverting to your question when you asked the benefits of investing locally.
I see. Yes, the initial one.
If we look at kind of the direction of travel, markets globally are becoming more liquid, more efficient, more competitive. In our view, our local market, and especially that which is outside of the top 40, we think is actually becoming less efficient. If you look at sell-side research, it's reducing. If you're looking at liquidity, it's been pretty much stagnant. Our industry is quite concentrated. The big managers have gotten bigger, and they sort of have become a lot more focused on offshoring a large part of their asset base. So we very much think that the local market is rich in terms of the ability to have active stock picking, generate returns. So that is a kind of structural view that I think is positive for everything from a hedge fund to a flex fund, where you have more tools at your disposal. That's what you want in this kind of environment.
Got you. Saul?
I think given when I spoke about that heterogeneity of our market, there are so many different, vastly different sectors in our small market, relatively small to other global markets. That difference between the sectors and the value drivers of those sectors means there's quite a lot of value to be added relative to a benchmark. So I think that's certainly, I think there's a lot for active managers to do in the SA market, just given that very low correlation of those various sectors that I spoke about.
Okay, and because I put Warren on the spot, it's only fair that I do the same to you two. Were you involved in Curro at all, Saul?
Sadly not. We do have exposure to some small caps, but we do not have exposure to that one.
And Matthew?
No, we don't.
It'd be interesting to see if we can find out who did, because we'll probably see it's a very limited pool of people who benefited from that. Yeah. But changing tact, we mentioned gold earlier. Warren, one of the things I noticed from your fund fact sheets and the reports is that you have a notable absence of gold in the portfolios, which have been a big driver of returns for many managers over the last 12 to 18 months. And that's been a conscious decision on your part, I believe. If you could just explain why your firm has taken that stance.
Yeah, I think we don't have any exposure to gold currently in the portfolios. We have historically, in our mandates, owned physical gold over time. I mean, it is an asset which is uncorrelated to other asset classes, and it does offer a hedge in turbulent times. When we look at the setup in gold and gold companies today, we see, yes, there's been a recent strong re-rating over the last year. But when we take a step back, we think this is quite a mature gold bull market, starting in around 2017, 2016. We think the gold price is relatively elevated, although we do admit it's quite hard to forecast where it goes from here. But when we turn to the gold companies, we see that they've significantly re-rated in South Africa relative to where they were in prior cycles. And that has been through positive management actions around improving the asset base and so on. But they are now pricing, and we think roughly the current gold price. And in gold companies, because they're so capital intensive, your future return generally comes from earnings growth. And our sense is that from here, it's going to be harder to generate earnings growth, and that there's more downside than upside. So the risk reward for us is not that attractive. So we find better opportunities elsewhere in the domestic market. I mean, as Saul pointed to earlier on, it's a very concentrated domestic market now. So gold and precious metals, you add them together, you're at 20% of the index. It's the highest weighting they've ever been. So it's a risk, and it's something that needs to be managed actively over time. But for now, we're quite comfortable to have an underweight in that space.
Okay. I'd like the opposing view for one of you. Saul, let's start with you.
I mean, we think the world has changed. It's certainly a different world to any kind of world that we lived in. If I think of not just my time in the market, but in fact my entire life, the geopolitical changes are significant. There are a lot of very sizable countries that are nervous in terms of holding a lot of their reserves in dollars, especially given we've seen that a country like Russia's had their reserves frozen. So I'm sure other countries like China, India worry about that happening. And I mean, we're already seeing some huge tension with India at the moment, with tariffs being hiked up. So countries worry about this. And I would think the natural place where they would put their reserves, if it's not going into dollars, or if less is going into dollars, it's going to go into gold. And that's what you've seen.
Or Bitcoin.
Sorry? Or
Bitcoin.
Yeah, that's I'll leave that for one of the other panelists. But yes, I guess maybe Bitcoin. But I think gold will certainly keep its place, given that it's been around for thousands of years, unlike Bitcoin. But that demand for gold changes a lot of the relationships that we often would have relied on. So, we would often look at things like real US bond yields, which had a nice inverse correlation with gold. And the story behind that was always it's an opportunity cost. If your interest rates are very low, then you can own gold, and that would push the gold price up. We've seen a bit of breakdown. We've seen a breakdown of that relationship. And that's not surprising, just given this change that we've had in geopolitics. So although the gold price has gone up a lot, as Warren pointed out, we think it may well stay there, and it may well keep on going up. And another factor that is also positive for gold is the rising levels of debt. And I mean, this is something that people have obviously spoken about for many years without any kind of pain being inflicted on markets. But we do think you don't just have rising debt in the US, you've got it in the likes of China, you're getting it in Europe now as well. That does have a negative impact on fiat money. Now, it doesn't mean that it has a negative impact on it in the next year or two, but over the long term, that is certainly a negative headwind for fiat money. And once again, the opposite of that is gold. So that's just another long-term positive driver of gold, which is why we still remain positive on gold, notwithstanding its fairly elevated rise.
Yeah. An interesting risk, actually, that I came across in the last couple of days is where the gold is physically stored. Because up until now, there's been this understanding that you have rights to gold, which is in some sort of reserve, but it might be in another country, usually the United States or Russia. So the question is, what happens if you want to take physical possession of the gold? It's an interesting question for the future, but we might start seeing gold shipments around the world and great train robberies and the like. Warren, you've already answered. Matthew, your view on gold and Bitcoin while you're at it.
So, look, we very much agree with Saul's view. If you look over very, very long periods of
Sure,
time,
guys, I'm dying for one of you to say, I disagree. Let's see if we can get to that. We want to hear that before the end of the session. I disagree, but carry on.
Well, Warren disagreed with
Yeah,
my view.
Look, if you look at sort of the decade-long performance of gold companies, it's true that they are horrible. And the reason for that is that over long periods of time, unit cost increases are above that of the gold price increase. But there are certain regimes through history where you get secular bull markets. So the 70s was a very evident one. The early 2000s was another one. And I think what we're going through now is a secular bull market. The commonality of all of those is it's a time when it's dangerous to hold normal currency or fiat money, as we talk about it. So right now it's dangerous because of high debt levels. And most importantly, it's the weaponization of the dollar. So that has started buying by these large central banks. Now they are gargantuan balance sheets going after what is quite a small market. Gold is not a big market cap if you look at it in context of financial markets around the world. So when they decide to buy, that buying can continue for a very prolonged period of time. And the other interesting thing about gold, which makes it both very hard to forecast, but it's also the benefit, is there is no supply response. So a normal commodity like copper, the price goes up. What you eventually get, and it can be delayed, is increased mining production, increased copper production. Most of gold sits above ground, as you mentioned, and therefore the actual price level doesn't shift supply. So that part of the equation actually doesn't work as an equilibrium. Bitcoin is very much got the same appeal as gold, other than the fact that it's newer. And the other difference is that there is a uncapped supply of cryptocurrencies. So yes, Bitcoin in and of itself may have a capped number of supply, but there can be a continuation of cryptocurrencies invented which may dilute its value. But let's see where that goes. It is what's very evident is it's growing in institutional acceptability, which definitely is a bull case.
Yeah, but interestingly, it's driven entirely by demand. No utility whatsoever in it so far. Maybe people trade a bit with Satoshis, what I think it was mini Bitcoins, but it's entirely driven by investor sentiment and people pile in. Raises
Exactly.
questions about whether it's a bubble or not, but we could have a whole discussion on that. Yes, it is. But it's also a speculative asset rather than a store of value right now. I'm not convinced personally that it's a store of value right now. We mentioned banks. We all have general exposure to banks, and you've picked up that exposure to banks. And in fact, Matthew, from what I've seen, you have the largest exposure. What do you see the opportunity? And we're talking about SA banks here.
Yeah, so we have very much kind of decided to take our SA Inc. exposure through financials. So if you look at what's happening in the economy and we look at all the different results that we're seeing out of all the different sectors, we're still relatively concerned around the health of the consumer. It's a steady progress, but it's very slow. The rate cutting cycle is pretty shallow. So if you look at the SA Inc. sectors, the one that we think is the most attractive is financials, because if there is a revival in SA GDP growth, it's likely to be infrastructure and corporate credit led. And that's where the banks will play to a large extent. So, a slow but gradual consumer environment is good for the banks, but really the kind of real delta or optionality that they're offering at the moment is in, should we see reform coming through, and it's coming through, but really, really slowly. But if it does, you have big optionality in terms of banks' earnings. What we're also seeing at the moment is that they're doing very well out of market volatility. So if you looked at the results that came out in the half year, a lot of them are making very good money from their corporate investment banks, from the volatile market conditions. So you've got kind of a significantly more defensive businesses in the banks than you do, for example, in a discretionary retailer, which is really kind of at the pointy end of that consumer story. And then the valuations are attractive. So, in many counters now, you're sort of getting dividend yields that are equating to that of a 10-year bond yield, but you still have this optionality of growth.
Okay. And I've noticed, Matthew, while you're holding ABSA and First Rand in your top 10, Truffle prefers Standard Bank and Capitec. So why those two banks?
Sure. So one of the things we like about Standard Bank is they have sizable African exposure. And there's quite a lot of infrastructure work happening in Africa. The Chinese are investing, and Standard Bank is benefiting from that infrastructure financing. So you're getting quite a bit of diversification away from SA in the likes of a Standard Bank. Not that we think that you'll get terrible earnings out of SA. You will get some level of SA earnings. You will get some growth in SA earnings in Standard Bank, but the fact that over 45% is Africa and that's growing nicely, that we think is a great opportunity for Standard Bank, which is why we have exposure there. You're actually seeing ABSA also growing their Africa pie, and that's sort of in the 30s as well now. So you get that benefit, which we like. Capitec we like because it's one of a handful of shares that are actually going to grow by a growing market share as opposed to being reliant on GDP growth. So Capitec is not a cheap share, but we think that they can really double their market share in the likes of business banking. They still have a lot of market share they can take in SA. So we see very high growth for quite a number of years from Capitec, which is why we also really like that counter.
Okay. And Warren, you can answer the same question or explain the cash position you have, because I've noticed it's a bit of I don't want to say outlier, it's just you have a larger cash position, and there must be a reason why you've decided to do that.
Yeah, so I'll start with the banks and financials. I mean, we would agree with Saul and Matthew. So we have a pretty, I'm looking at the numbers now, close to 19% of the fund is in financials. So we got our core banking holdings, and we have a bit of a barbell there where we have some Capitec and Standard Bank for very similar reasons to that Saul alluded to. Then we own on the quite cheaper end an Investec, where we think there the business has been transformed quite significantly by the management team, and we think that bank should start to grow again after many years of consolidating. But then more interestingly, within our financials, we also got these opportunities where we think there's, I'd hate to use the word, but asymmetric kind of return profiles, something like a INN8, which they've now disposed of their largest investment. They're sitting in 80% post this transaction closing in cash, and it's trading at a 30% discount to NAV and 15% discount to its cash holding. So we think there you've got an asset which has quite limited downside if the markets were to correct, but there's also the opportunity of some sort of corporate action there. So we like the financials. And then if I turn to the fund's cash balance, I think it's important to look at maybe over the last year how that's evolved. Post the GNU, we acquired quite a significant position in government bonds, similar to what Matthew was talking around the opportunity there. You could acquire these government bonds at 12% plus yields to maturity. They subsequently rallied strongly as the sentiment towards South Africa improved. That peaked at around 18% of the fund. And then during the second quarter of this year, we rotated out of a portion of the longer duration bonds into cash. So we will always run this fund with a reasonable and healthy level of cash. It's where we allocate that cash to between bonds and money market. And right now we've got a higher portion to money market. We think 7.5% return in a 3 to 3.5% inflation environment is a reasonable place to be with limited chance of capital loss.
Okay. As I'm listening to you all explain that, I'm thinking it might be difficult for some people in the audience to connect how you're describing the investment philosophy with specific cases. And when we talk about things like Kuro, or we talk about individual bank names, it makes it a bit more real. So can I ask you each to think of an example of an investment decision that you've made or didn't make, maybe something you chose not to invest in, that demonstrates your investment thinking and how you function as a firm? Matthew, can I start with you?
Sure. So maybe something that I alluded to earlier, kind of having that hedge fund mindset and risk management overlay. So for example, we've owned a very large position in Naspers Process. We think it's the fundamentals there look very attractive. But of course, you run risk when you're running quite a concentrated position. So one aspect that we did is we actually bought put options on that name. So put option is something where you pay a premium, and if the price drops, you effectively get paid the difference between the strike and where the price ends up. So it's downside.
Like an insurance policy.
It's an insurance policy on a downward move in the share price. So what that allows you to do is to actually keep your large long position, because you're trying to manage risk. So the one thing you can do is you can just simply reduce your position. But if the share price subsequently rallies, you miss the upside from that position. If you have a put option, you pay the premium, but you are still able to capture the full growth on that initial position. So that was one example that maybe kind of gives you a sense of sort of risk management within the fund.
Thank you. Saul?
There are a few examples. I mean, one of the things that I spoke about in my intro was that we try and estimate an intrinsic value, and the fact that we actually like share price volatility, because that's what presents us with the opportunity to buy cheaply. It's when shares sell off aggressively below what we consider this intrinsic value. An extreme version of that would have been during COVID. You had markets everywhere sold off, including our own, and you had some high quality names that got sold off, Capitec being one of them. I think it went down sort of 40-50% in a matter of days, and then that for us was a fantastic opportunity to take, is to buy a sizable stake in Capitec. I mean, we recently had Anheuser results. We're overweight Anheuser. Market did not like their trading updates. They were struggling in Brazil because of bad weather. And the shares sold off. We actually used that opportunity to up our exposure, because we really felt that was very much a once-off issue that certainly should not impact the long-term cash flow generation and earnings of the business. So I mean, that's an example of us buying below intrinsic value. The other thing we really like to do, or ensure that we do, is when things change, we change our minds. Things can change for companies can change. Discovery's often been a business that we haven't liked, usually because of its cash flow dynamics, which have been a bit poor. But if we go back sort of a year ago, we really saw the fortunes of Discovery changing due to a number of factors. One of them being the fact that their bank really was gaining traction. So you had a business that was loss-making, swinging from losses to profits, was going to have a huge benefit on the overall earnings growth trajectory of Discovery. You had some improvements in some of their offshore businesses. So we actually changed our mind on Discovery at that point and actually took a position because of these changes that we were seeing that certainly were not sort of clear if you go back more than a year or two ago. So hopefully that gives you a bit of a...
Yeah, it's very useful. And Warren?
Yeah, I think I can talk to our hedge fund background as an example. So in our funds, we utilize pair trades. That's generally where we will go long a name we like, or we think has good upside, and we will be short a name which we think there are either issues or that we have a limited upside in our valuation. So something like a SPAR, ShopRite, where we've been long in the hedge fund ShopRite and short SPAR. So how does that informs us in our long only mandates? We will own a ShopRite, but we will avoid owning a SPAR. So that hedge fund work we're doing on identifying short positions also means that it flows through to the kind of businesses we won't own. And a ShopRite is an example of a business we think is been investing very heavily over the last 5 years, as it's taken share from its competitors who have been very weak. And we think they're on the cusp of now pulling back that heavy capex and starting to push the returns on that, which will generate stronger earnings growth in the next few years. And it's kind of trading at a multiple that's not very demanding versus history. So that's one example of how the hedge fund mentality works its way into a long only fund. And then also in that big sharp April sell-off, there are many names which were sold off indiscriminately. I'll talk to a Remgro. We added quite a lot of Remgro near the lows at almost a 50% discount to NAV. And that's a holding company where we think there also is some inflection about to occur. We think earnings growth are going to start accelerating, cash flow to the center, and they've managed to do a deal on Massive, on the telecoms deal, where they'll be getting 5 billion rand to the center. So a very strong balance sheet. So that type of thing where we've done the underlying fundamental work and we utilize the market volatility to add to them, similar to what Saul was talking to.
Okay, thank you. I want to pivot slightly as we get towards the final few minutes of this. We've also noticed that all three of you have reduced your allocation to bonds in recent months. And, the common wisdom on the street is that interest rate cuts were coming, certainly that we're expecting them at some point in the US. That should be positive for bonds. So why reduce your holding now, unless you think that the recent cut we had in South Africa represents that opportunity and it's now gone?
Yeah, I mean, we've actually been cutting our exposure to duration. I mean, we think SA bonds have done particularly well. Some of that is obviously due to inflation targeting. Well, the SARB wants to get to 3%. We have yet to see whether that actually happens. There's obviously some tough headwinds. You still need Treasury to buy into that, but we've seen some of that being discounted into bonds, and maybe we're also seeing the likelihood of our grey listing being taken off. So maybe that's also driven our bonds. But that's really why we've actually been cutting back our exposure. We're seeing better returns out of some of the shares, and financials has obviously been discussed quite a bit here. We think we're getting a better return there than out of SA bonds. So yeah, we've actually trimmed our duration quite a bit from here. One other thing that we worry about long term is we think there is a tail risk for US bonds to blow out. Not saying that's going to happen, but given what we're seeing with debt dynamics in the US and Trump targeting the Fed, I don't think any of this is good for long-term interest rates. They're being artificially kept lower in the US by the fact that they're funding very, very short at the moment. So there hasn't been a lot of issuance in the middle of the curve. So that really talks to these risks of yield, these tail risks of US yields blowing out, which would filter through to SA, because we obviously are impacted by what happens there. So all those factors really talk to our cutting back.
And to be clear there, and I think for the audience as well, when we talk about the tail risk, you're talking about a low probability but high impact event where it could happen that interest rates spike in the US rather than being cut. Understood.
That's right.
Warren, you were going to chip in there. Sorry.
No, I just wanted to chip in on what Saul was saying. I think we've also had a similar action, like you alluded to earlier on, in our funds, reducing duration. But I mean, what we've seen is that the risk premium that South African bonds has traded over US Treasuries has come down quite dramatically this year. Then some of the factors that feed into that. So if you look at the credit default swaps on South African debt, that's trading at a 5-year low. The expected inflation in South Africa over the next 5 years is at also a 10-year low. So there's certain factors that we think have now played out into those bond returns, and the risk reward again is now more to the downside. And one must not forget that the South African fiscus, if we don't get this economic growth coming through, the debt to GDP does become an issue in outer years, and that we think will push out your longer dated bond yield. So although the real returns or real yields available on our domestic bonds are still attractive, we've moved more into cash and maintain a shorter duration in our funds.
So I have one last question for each of you before we wrap up, which is, if you could, in less than a minute, explain the scenario or the conditions in which your strategy will perform best, but also where it would struggle, just to give some context to the audience. Saul, let's start with you.
Sure. So this kind of mandate obviously has fairly high equity exposure most of the time, and our equity exposure is reasonably elevated, being over 70%. So we will be subject to the ebbs and flows of global equity markets. If we do get a huge sell-off in US markets, and that maybe that's recession related, there could be a number of factors. Maybe we have an AI issue where there's just too much froth there. So that would feed into our SA markets, and it certainly would hurt our performance in the short term. We obviously do have exposure to SA equity. So if we had a very negative event in South Africa that resulted in SA assets selling off, that would also hurt our performance. I mean, one of the points I suppose I would make is in terms of a global market sell-off, although that would hurt us in the short term, I don't think that would hurt performance on a medium-term view. What we buy generally, we look at owning over a few years. We make sure that we buy into sectors and shares at reasonable valuations. So that essentially means that if you wait for a long enough period, you will get a reasonable expected return. So sure, short term, we could see pain in this huge sell-off, but we think over the medium term, we aren't really concerned about our returns being negatively impacted. There are sectors within the portfolio that we do have some larger positions. So, shares like Naspers, we obviously are a bit dependent on what happens to Tencent. We do have a bit of a gold position. So there are various parts of the fund where we do have slightly higher exposure, and that will obviously be good or bad depending on how those sectors perform. But we have a fairly diversified spread of sectors, so it would be unusual for all of them to underperform other than a global sell-off, which we think would have a temporary negative effect on the fund.
Okay, and Warren?
I mean, being an SA flexible fund and having our asset allocation majority to domestic facing names and what's available in the rand hedge space, I think the best scenario for this fund would be the SA economy beginning to grow and seeing structural reform coming through. I think that would be
I think that would be good for everyone.
I mean, frustratingly, we've kind of been talking about it for a while and thinking things are going to start improving, and it's taking longer. But if we had growth in this economy, there will be so many companies that would benefit, and there will be stock picking opportunities. It'll just be fantastic. I think alternatively, asked what would be the worst case outcome is really the opposite. If South Africa just continues in this really slow growth environment, and we see continued delistings and a market that becomes much more concentrated, it does make the fund manager's job a lot more difficult when you have a limited pool of assets to invest in.
Completely agree. And Matthew, last word over to you. Best and worst case scenarios.
Yeah, so we're an active manager. So we want a high level of dispersion between sectors, and we want a high level of dispersion within sectors. Dispersion meaning differences in your sort of winners and losers. That's the kind of market that we think we add the most value to. The current market that we're in this year has been one that's been very much the opposite. You've had certain parts of the market that have done tremendously well, gold, platinum, some rand hedge shares, and pretty much the tail has actually been pretty weak. So you've had kind of just a very sort of obvious sector difference, but the sectors themselves have been very highly correlated. So we would, that being said, we think that's at quite an extreme. So the market going forward is more likely to be, a lot more kind of volatility within the individual sectors. That's great from a stock selector's point of view. Yes, I mean, we run relatively net long. We've got sort of 70% equity exposure. We've got pretty significant duration exposure in bonds as well. We think over time you want exposure to risk assets. Through the medium to long term, you want exposure to risk assets. So to take kind of short-term volatility is very much well worth it over the long term. But we kind of want to beat the index. That's what we're here to do. And we kind of think of the environment as, which environments are going to be better for us to do that in.
Okay. Thank you for that, Matthew. Thank you, Warren. Thank you, Saul. I like the time and the viewpoints. We didn't get to that fundamental I disagree, maybe next time, but there are obviously differences in opinion and implementation. If you all did things exactly the same way, we would only have to buy one fund. But because we look at the world and develop different viewpoints, it's important for investors to blend strategies like these together. If you're in the audience and you're wondering how you can access Bateleur, Laurium, or Truffle, well, one of the best ways is through an INN8 Invest solution, whether it's a model portfolio or a unit trust. So gentlemen, thank you very much for your time. I'm going to change gears now and invite a guest from the new Standard Bank International Investment Platform. Thank you, guys. Thank you. Standard Bank has been very busy in the last few years developing a new state-of-the-art global investment platform. With advisors facing demands from clients for more international investments, options, and accessibility, it's a welcome addition. So joining us to explain what this is all about is Sherry Lee Stratford, an international investment specialist. Sherry Lee, if you can turn on your camera and join us, I'd appreciate that.
Morning, Andrew. Can you not see me?
Yes, I can now. Sorry. Sorry. You were silent, so it didn't pop you up. There you are.
Okay.
Right. In the spirit of having an open discussion, let's set the scene. What is the new Standard Bank International Platform, and why does it matter for advisors?
Okay, well, I see it more as an international investment solution for advisors to assist your clients in gaining, and as your other managers have alluded to, diversifying their investments offshore.
Okay, so there already are other international platforms. Why do you think this one is different?
Well, I think we must look at the group. So we're coming with the holistic offshore investing. So it's not just what are you saying platform, more product with financial benefits, tax planning benefits, as well as estate planning benefits. We've also got the offshore fiduciary, offshore structured notes, offshore banking, and an offshore DFM. So it's the whole solution that we're coming to the market with, not just the investment vehicle.
Okay, and this obviously replaces any previous international platforms that Standard Bank has been offering. And I think it's important when advisors are looking at their choice that they understand what some of the different criteria are and what some of the pressure points are and the benefits. So what should advisors or clients be looking for when they consider what makes a good investment? I say platform, you were saying solution or gateway, but what criteria, what should they be looking at?
I personally think if I was an advisor, I would look to partner, first of all, with an offshore provider that has the whole suite, the offering, the offshore bank. But more importantly as well, what I see in the market, a lot of clients, their children are migrating. So
Hmm.
you want to partner with an offshore investment provider that also can cater for the next generation that might not reside in South Africa. Because as advisors, we want to continue managing their wealth. We don't want to lose the next generation's wealth.
And that leads on to a couple information questions, if I can, just to help people understand. So the first is, where is this platform going to be domiciled?
Jersey. The platform is domiciled in Jersey.
In Jersey, in the Channel Islands as well. And will there
Correct.
be an international endowment, or is it just straight investment accounts?
Now, I'm pleased to say we've come to the market with the international endowment. So we've come to the market with both the capital redemption bond, which a lot of clients might refer to as a sinking fund, as well as a life insurance bond. There
So
are
there's
different,
both.
yes, there are both. There are slight differences between the two. To mention one difference is the life insurance bond, you have an option of beneficiary of ownership or beneficiary of proceeds. This becomes quite an important question when looking where the beneficiaries reside. So that's quite an important question. And we also have the international investment option, Jersey domiciled. So it's a Jersey nominee account. We do not, it's not an SA nominee account, and it gives you can have multiple owners, unlike SA
Okay.
nominee accounts with one owner.
So you'll have, okay, multiple. That's a good thing to know. And I believe you told me before this call that there is family pricing or aggregate pricing that will be available in future.
Yes, so at the moment we are family aggregating, as well as I'm pleased to also say we will also be aggregating with INN8 local. So we'll look at the entire family with all their assets on the local INN8 platform, as well as the SBR offshore platform.
Okay, that's great. I wasn't aware of that. And I'm sure a lot of people on the call might be excited to hear that. Currencies, which currencies will it be available in for trading and reporting? Is it just US dollars
So,
or is it a larger list?
no, it's a much larger list, much larger list. And just to say, we are still in pilot mode. At the moment, we only have sterling, dollar, and euro funds on the platform, and we only
Mhm.
report in sterling, dollar, or euro currently.
Okay, and will that change in the future?
Definitely from a fund addition point of view, as we go to the independent market, yes.
Okay, so funds and will private share portfolios be available as well?
We already have a private share portfolio on the platform, and we will be adding a lot more custodians onto the platform. So at the moment, you can have a model portfolio managed by DFM.
Mm-hmm.
You can have an exchange traded fund trading directly on the platform, as well as a fund share portfolio, as well as structured notes. So we have structured notes directly on the platform for clients that might be looking for protection.
Okay. And the other thing that you teed me off to is that there'll be an integration with the Shift Currency app, as well as other large partners like Currency Partners. So people will be able to do the currency transfers on the
Correct.
platform as well.
Yes, at the
Okay.
moment we do work very closely with currency partners. Shift app is in the near future.
Okay, wonderful. So let's move beyond some of those static things. I think we people understand that it's a new, inclusive large platform that's going to have a large investment universe. And I think I really want to tap into your expertise, because I think most people, when they are in South Africa and thinking of investing overseas, are kind of a little bit lost. So what are the most important things that individuals should be thinking about when they're investing overseas? Or flip side, what are some of the most common mistakes that people make when they're investing overseas?
Well, I'm just thinking about it now. I'd asked a lot of questions initially, naturally,
Mm,
but I think the common mistake that I have seen is clients investing in feeder funds to get offshore exposure. Okay,
okay.
so
Why is that
I'm
a
a
problem?
firm,
Because that's quite common. That's what most people do.
yeah, I'm a firm believer that discretionary funds, if I want offshore exposure, I should externalize my funds. Why, do you ask? Because if I externalize my funds into hard currency, I will then save capital gains tax on any rand movements. And generally, over time, the rand does depreciate. So therefore, I would save capital gains tax on any rand depreciation going forward, unlike feeder funds. So I think if I've got voluntary money, and always look where the beneficiaries, if I'm building up a legacy offshore and my children reside offshore, why would I build up a
Mhm.
legacy in South Africa? Would it not be more prudent to build a legacy offshore that's payable anywhere in the world?
If the client is planning on doing that, I agree
Yep.
100%. But is it, just want to challenge this point. You said using a feeder fund, but if someone has 10 million or 20 million or 30 million rand that they want to invest, it's a great legacy. I can see the point in sending it overseas. But if someone has 100,000 or 200,000 rand, isn't it just easier for them to invest in the local feeder fund?
No, I do agree for the smaller investor, but anybody with over 250, 300,000 should look at diversifying offshore. And I just want to mention it is only voluntary money. So it's naturally
Mm.
not compulsory money where we are not taxed in the actual product, we're taxed on future income draws.
Okay.
So
So in your mind,
discretion
you're saying compulsory
voluntary.
feeder funds, fine, but if it's voluntary and it's completely your discretion, you should go overseas. Okay. Okay.
Correct.
And you were also saying that the endowment is an option, which gives people a tax shield as well and helps with estates as well, if people are doing that. You mentioned, is that a common mistake that people make? I was thinking more in terms of the way they set up their accounts or how they send the money or other things that people do, which you commonly see that complicates their life later on.
Um, can you just go back on that question, Andrew? Sorry.
Well, I mean, you mentioned feeder funds, people investing discretionary money into feeder funds, and you thought, that might be a mistake, quote unquote. But are there other things that people do that you see where you're like, oh, if they had just spoken to someone, they might have avoided some pain, like a common mistake that people will make?
What I see, and I've saw just actually for prime example, clients have offshore bank accounts. They have it in what name? They're unaware that should they pass away, it's a grant of probate. Nobody
Mm.
tells them you can have two account owners on an offshore bank account. So I see a lot of clients with offshore assets that aren't aware that should they pass away, it's going to be the the organization will request a grant of probate, which can take ages because we still have to wait for the SA executor to be appointed and then appoint the offshore executor. So I think that's what I'm seeing a lot of when clients aren't preparing for if in the event of their death, how are the assets going to be distributed to theirs? And that is
That's
where
a
the endowment is a win-win.
Yeah, and that is a great point that you just made, because a lot of people are not aware of the fact that if they have overseas assets, generally speaking, they need to have a will for that jurisdiction. So for a bank account or property in the UK, for example, they would need a UK will and a South Africa will. Does that apply if someone is investing via an international endowment?
No. So with an international endowment, be it the capital redemption bond or the life insurance bond, you nominate beneficiary of proceeds or beneficiary of ownership. So
Mhm.
on your passing, 2 to 3 weeks, the assets will be passed on to your intended heir. And what else we do? We save on executors' fees. And talking about death now, a lot of clients hold indirect share portfolios onto way of Citus tax. The endowment gets around the Citus tax. No Citus tax is applicable for offshore share portfolios inside an endowment.
Okay, wonderful. And will there be, so this is a factual question as well, I just thought of, one of the biggest complaints that people have had in the past is they're unable to make recurring payments into offshore accounts. Is that going to be something that's included in this new Standard Bank International platform?
Glad you asked that. We are looking at Andrew, and yes, we are definitely looking at recurring contributions going
Wonderful,
forward.
because there are an awful lot of young South Africans who work overseas and want to be able to contribute monthly. Okay. Let's see. Let's say I came to you and I said I had 15 million to invest. And I chose 15 million because that's over the discretionary amount, obviously. So it's a slightly larger amount. If I came to you and said I have 15 million rand to invest overseas and it is voluntary, what are some of the most important things that you think I should consider? Or, and obviously these may be things that a good financial advisor or yourself might highlight, but what are some of the things that you think people need to think about when they're taking a sum of money to invest overseas? Let's say voluntary.
Okay, well, first partner with a good advisor, which I'm sure in the crowd they're all good advisors. So I'd first say partner with a good advisor for holistic financial advice. Um, the client has exceeded the 11 million rand. What I want to mention here, the million rand single discretionary allowance we get, please be aware that should I go and buy books on some offshore site and pay on my credit card, that forms part of my million rand allowance. And SARB will pick it up. So I just want to bring that. Diversification is always a winner, as your panelists have alluded to. So diversification offshore, maybe look at a good DFM, an award-winning global DFM like INN8 Invest.
Thank you.
Partner with. Also, I want to mention you can apply for special tax clearance because you have got 15 million. A lot of clients I feel don't want to apply for the special tax clearance, and therefore they utilize an asset swap. So I'm pleased to say we've come to the market. We do have asset swap directly into our offshore endowment. So all the taxation benefits will be applicable to individuals, SA trusts, and SA companies looking to diversify offshore without an offshore discretionary allowance.
And so I just want to pick up on something you said. You mentioned trusts. We've been talking mostly about individuals. What is this about trusts and companies who want to externalize?
So there's a trusted company, they don't get a foreign discretionary allowance. So they have to utilize asset swap. So an SA trust or company could utilize Liberty's asset swap, going directly into Standard Bank International offshore endowment. What does that mean? The tax will be calculated in hard currency, in dollars. What does that mean? The trust, as well as the company, will not be paying tax on rand depreciation. And as we all know, SA trusts that invest in endowments, we all look down to beneficiary level, and they are put in the individual policyholders fund. If all natural persons are beneficiaries, they will be put into the individual policyholders fund, and capital gains tax will apply at 12%.
Okay, so it is important to get these details right. I mean, that's what I've been picking up on in the conversations I've been having and listening to you. It's very important to start off right, get good advice. You mentioned, I mean, thank you for the name check for mentioning that INN8 Invest has won awards as a DFM.
Very
But
impressed, very impressed.
do you think it's important for individuals and advisors to have some of that pre-vetting or model portfolios or research which is there to help them make decisions when they're choosing funds or solutions overseas?
I'd say, especially in the offshore space, because there's such a wide array of fund managers. So I would say the offshore space, I would definitely look at maybe partnering with the DFM to definitely assist me with managing a model.
Okay, I appreciate that. Thank you again. I guess my last couple questions for you, just mindful of time. When will this be available for IFAs?
Well, we're in pilot stage, as I mentioned. Q4, we will be launching to a select number of IFAs, but during the course of next year, early next year, we will be going to the IFA market.
Okay, so people can perhaps reach out to us if they want to be part of that pilot, but otherwise it'll be rolled out in the next few months and early next year.
Just liaise with their broker consultant or their investment consultant.
Cool. Shirley, thank you very much for joining us. I'd like to point out that Shirley has a counterpart named Zell. They're international investment specialists who will be based across the country to help advisors when they are using the new international platform. So they are there to assist you with not financial advice, but guidance on how best to structure things and implement on the platform. Shirley, thank you very much for joining us. I will speak to you soon. And for everyone else who's on the call, well, we're almost at the end. Time is always the enemy in these things, and I did promise to get you out here before 11:30. As we close today's webinar, the key message I would like to leave with you is that the landscape for advisors does seem to be getting more complicated. We heard from Shara Lee talking about the choices. We also heard from the the asset managers. Whilst we were talking about South Africa, they were constant references to what was going on around the world. So it's important to choose good partners who will elevate your business by providing flexibility and additional options. INN8 Invest is one of the country's leading DFMs, is well placed to help you. So please, if you are thinking of working with the DFM, make sure that we are one of the choices that you consider, and we'll see what we can do to help elevate your business. This webinar has been recorded. There will be CPD points available, and the recording will be made available through Asset TV on the INN8 Invest website and other leading channels. All that's left is for me to thank the panelists again for contributing and sharing their thoughts. And to you, the audience, thank you very much for attending. I hope you enjoyed it and found it useful. Until next time, thank you and goodbye.
INN8 Invest is a division of Stanlib Wealth Management Pty Limited, an authorized financial services provider.